and we're going to go right into our next segment, which is Wrap of the Week. This is where we take a step back and look at some of the big picture thematic shifts over the last 5 trading days. We asked you recently on our StockCharts TV poll. We always have a poll running on stockcharts.com/TV. Check it out, and please make sure your vote is a great way to maintain a good dialogue between us, see what you're thinking, and incorporate that into some of our discussions. We asked you, what do you think you provide the best returns over the next 3 months? And we asked this over the last couple of days. 70% of you said large cap stocks, the S&P 500. 12% said the mid cap index. 16% said small caps, IWM. Only 2% of you said micro caps, the IWC. So interesting to see, 70%, over 2/3 of you said the S&P 500. When I'm asking that question about cap tier performance, I immediately start thinking about some of these charts, which are comparing the returns of these different cap tiers, large versus mid versus small versus micro caps. And so I'm going to look just year to date to show you how these things have evolved. And so where I think many of you are coming from, which is totally valid, is if you take year to date, and this, obviously there's been plenty of movements between there. You had the market peak in February, the market sell off into March, but look at how large caps really remained above everything else pretty consistently. That departure happened really right out of the gate. So in the first couple of weeks of trading, the large caps were the one out of the 4 that were still in the positive, while some of the others were pulling back a little bit. Made a higher high while most others made a lower high, which was one of the great divergences of, I think, that February peak. If you look at what's happened since then, everything's recovered. Mid caps have actually been the #1 performer out of the market lows, but year to date and since the February high, you still have large caps being the top gainer. Now, a lot of people have speculated that, and while the S&P has remained relatively stable, a bit of a lower peak, but not much, you can see that some of these other cap tiers, especially small caps here in green, have made a confirmed lower peak, so sort of already breaking down before large caps. While large caps sort of in this sideways trend, these other 3 certainly to me appear to be in more of an established downtrend, a tactical downtrend of lower peaks and lower values. So I see what you're saying, and that's not a bad call. I think if the market does pull back from here, I think you're in a good place to favor large caps over other parts. We're going to look a little later about relative performance of small caps. I'd want to see that improve before I would answer anything in the bottom half of that list of cap tiers. So thanks for answering the question. I think for the most part, I think you guys are in good shape in terms of where you're thinking of large cap performance. Certainly seems to have been consistent. Let's go to our Mindful Investor Live chart list. This is the way that we review things on a Friday to make sense of them. We're going to start with this market trend indicator. This is something I've used for a long time, a number of years, and it's based on long-term weekly averages. So this is the weekly 21-week and 34-week exponential moving averages here in the top with a weekly S&P chart. So my long-term view is basically looking at which one is above or below the other. So this turned negative sort of mid-March as the market was really selling off, and really near the bottom is when it finally turned negative because it was enough of a downtrend. It has remained negative based on what's happened since then, remains in a bearish posture. So the long-term signal by my read is still negative. That's why I still see this as a sort of a bear market rally. The medium-term signal came very, very close to registering a buy signal this week, but didn't quite do it. It's still sort of just narrowly favoring the bearish point of view. And so overall, the medium term, which is based on the weekly PPO, based on the traditional settings, the 12 and 26 and 9 bars. So that's, or periods. And so that's remaining in a negative signal. The short-term signal is the difference between those two. And that's sort of how I read my model. So this increase that you've seen, this narrowing of the moving averages that turned in late March has remained positive. So, my read still remains short-term. The tactical read is positive. Medium-term, long-term still bearish, and very, very close to registering a buy signal on the medium term. That feels about right to me based on what I've seen and nearing those significant resistance levels. This is the resistance that we looked at earlier, 2950 to 2800. I think that's a key range, and one of two things is going to happen. We won't remain in this range forever. Either we break to new highs and break above the 200-day. I think in that case, you need to feel bullish bias long and strong up and to the right, aiming to 3,400 to be honest, or we break down through these support levels. We validate this the meaningfulness of this resistance, and we're heading down to the 2,400, 2,500 range. In terms of breadth, this is something we looked at earlier in the week. I think one thing that concerns me about the overall longer-term strength of equities is this breakdown in the cumulative advanced decline lines. They've all established a pretty clear lower peak and now have gone to a lower low, and that's unique. That's the first time that's happened since the market bottom on March 23rd. So that tactical read now is turning a little more negative. I think that's where the breadth has been a little more concerning. You know, if you look at the new highs and new lows, it's a little zoomed out, but if you look, you're just starting to get very few new highs in the equity space. But if you look at the S&P and the New York Stock Exchange, you're starting to get more and more, especially this week, more and more stocks making new 52-week lows. We haven't seen that in quite a while, actually. This is the most we've seen since the first week in April. It was that first pullback after the V bottom, that major bottom in March. So starting to see some new lows, more and more of those in the coming week or so. And I think that suggests that we're getting the rollover that I think many expect. By the end of the week here, you've had a lot of stocks sort of toying with their 50-day moving average. The S&P 500 remains above it, but if you look now, just over 50% of S&P stocks above their 50-day. So it's right about half and half. Only 26% of the S&P names above their 200-day. So just like the S&P remains below its 200-day moving average, most stocks still in that configuration. Again, I think that to me sort of confirms that medium-term bearish sentiment. You get that breaking above 50, over half of S&P stocks getting back above their 200-day. I think you can be a little more optimistic about long-term prospects for the equities. In terms of sentiment, the one I tend to look at is the AAII rankings. Just in general, you've had this trend of less and less bullishness coming out of these market lows, and so 23% of respondents bullish, 50% still negative on stocks here. Just a couple more ratio charts to finish out our read here. One of the ratios we love to look at is the ratio of consumer discretionary to staples. That is has sort of stabilized but continues positive on a cap-weighted basis. On an equal-weighted basis, though, has been turning lower, and that's been for the last couple weeks. I think we've continued this pattern. So, you take Amazon out of the picture, and overall, you sort of have favoring staples over the last couple weeks. You actually saw a number of staples on the Scooter gainers list today, which is sort of interesting. Then the last one I wanted to point it out was just the relative performance of semiconductors. Semiconductors really over the last 2 months, last month and a half, since that first move out of the March lows have been sideways. They've been sort of a market performer. I would love to see this break out to new highs to confirm further upside for stocks, and we've not seen that yet. On the other hand, if you start to see this breaking down to new swing lows, which we have not seen yet, if you start to see things roll over a little bit there for the SMH, the semiconductors ETF, that tends to be a good leading indicator for stocks. I think that might validate more of a bearish thesis in the coming weeks. That's our wrap the week segment. Again, so many charts to go through. I try to hit on some of the key ones that have jumped off the page during my normal weekly review. We're going to take a quick commercial break. Back opening the final bar mailbag and answering your questions. We'll see you in a minute.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.